Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely related to the precious metals. And this week, honestly, we could almost hit replay, Miles, on last week's show because of the lack of activity in terms of significant changes chart-wise or fundamental-wise. There just hasn't been a whole lot going on. And so without further ado, let's have you just kind of take off and show what's transpired in gold.
Sure. So we've been talking about the retracement on the way back down, some of the lows dating back to, the low back we had in December last year, November, obviously the big one back in October, down the 1800s, and looking at some of the levels gold could retrace back to. So let's look at it the other way, just for fun, since gold's been rising back up after it got down sub 2000, down to around 1985 back on Valentine's Day. So if we kind of look at where gold started, the decline. So this decline really started when we double topped. That was the second top we hit right after Christmas on December 27th. That was around 2087, 2090, somewhere in there. And coming down to that low I just mentioned at 1983, the bounce we've had thus far is now kind of trading up and down sideways between the 382 and the 50% line on the way back up. So those are a couple levels that we need to see us get back above. Realistically, we don't get to start talking about higher prices in gold until we see a higher high. I would argue that number needs to be above the beginning of February high, which also goes back to the January high. This is going to be around 2060. So we've got a little ways to go, and gold needs to kind of establish a foothold on the way back up before I'm going to start screaming bullish. Now, we did get our first signal in that low in that 1984, 1985, where we stopped here about 2 weeks ago, that actually stayed above the December low, 1975. So it was good to see that we bounced at a slightly higher low than what we saw a couple months ago. And I think if gold can hold here in this low 20 range without showing too much resistance to the upside, I think eventually it could knock through that door and push on through.
Well, it would be good, and I appreciate you going to look at the upside. It is good to look at entry points.
I got to do it occasionally.
Well, yeah. I know you prefer to be bearish, but there'll be a day that you're not.
I prefer to buy gold at cheaper prices.
That's
is
right.
What I prefer. That's what I prefer.
I concur. I agree. But yes, in terms of those downside levels, we've been beating on that for a while, and to remain encouraged, especially with where gold is. Arguably, it could certainly be lower, but there's just too many fundamentals keeping it propped up. There's an air of concern. It's not just spring in the air here, right? We've got uncertainties in the air. And as our country wrestles with things like economic stagflation and obviously increasing federal and household debt, this year we have political uncertainty on top of the escalating geopolitical tensions, social division that everybody's feeling, and then obviously now a restructuring potentially of the world monetary system with the de-dollarization. All of those things have people buying gold, and you're seeing it in central banks. You're actually seeing it move from west to east, however. You've got a lot of outflows in ETFs here in the United States, but it's adding to ounces in the East. And so all of that is helping prop gold. And so arguably you could say, well, the gold to silver ratio shouldn't be at 90 to 1 like it is. It could be much lower. Is silver undervalued, or is gold overvalued? Or is it somewhere in between? And that we don't know. So looking at the silver charts, again, not a whole lot of activity this week, but let's do a little figuring just in terms of what we could see there, and then let's talk about the ratio.
And the ratio is a great thing to bring in, because if you look at silver just from a price perspective, silver is definitely not undervalued, but it's also definitely not overvalued, at least in terms of US dollars. We've been looking at silver trading in the same low to mid $20 range for a year. So I think it is important when you have to take a step back and start thinking in terms not so much of how many US dollars can I turn my gold or my house or my car or my stocks into, but how many of a relative or adjacent asset can we look at converting? Can you swap apples for oranges and end up with more oranges? When is the right time to do that? So that's why we tend to discuss a lot and bring in the concept of ratio trading as a company, because it's one of those ways where we can look at a precious metals position, which, doesn't do a couple things. Gold doesn't provide income. Gold is primarily meant to be the bottom of what we call the financial triangle, the foundation, that which can't go to zero. But in that, there are some investment strategies that are built into it other than just waiting for the dollar price to go up. So this is why we look at things like the ratio, because you look at silver over the last couple of years and you've had some staggering ups and downs, but it's all averaged out to the mid-20s. So if you look at it in terms of dollars, you really haven't gone anywhere. But if you look at it in terms of ratio opportunity, there might just be a couple little things in there worth thinking about.
No, that's exactly right. And this is actually now with the ratio above 90 to 1 again. Look at it as somebody that was able to get in 2021 when the ratio had come down into the mid to low 60s. You're looking at an opportunity here to move some of your gold to silver, but each portfolio is so different. Everybody has a different entry point, as you know. And so our encouragement is to call us and we'll just run through. We'll help you find cost basis. We'll help you find ratio on the date that you acquired your ounces if it wasn't through us, and then advise you on what your target exit points could be in terms of moving percentage-wise into one metal or the other, depending on how heavily loaded you are. And if you're diversified. And that's really the key point, is you've got to do it dynamically. You've got to get set up right on the front end and have exposure to both metals. We don't know if the ratio keeps going, right? Back in 2020, we saw it get to 125 to 1. That was an outlier event that exceeded the previous all-time high of 100 to 1. But I'll tell you what I'm most excited about here is we don't need those outlier events. We're going to do it conservatively with higher repetition. And the whole objective, again, is to compound ounces over time. It's not just a one-time trip. So taking 2020, for example, when that ratio got to 125 to 1, imagine instead of buying gold there, you buy silver, and we're able to then, just a short time later, 10 months later, move that silver into gold, and you end up with 50% more ounces than you would have had you bought gold back in 2020. And that's huge. Instead of buying 10 ounces of gold, you end up with 15 without having invested any more money. Well, imagine that on a grander scale or with increased frequency. And that's where the generational effect begins to occur, is that if you look at your tangible physical metals as your long-term store of value, as you just described it, Miles, where we have this opportunity to take our hard-earned income and move it into a store of wealth, but yet we can diversify within the tangible metals category. Well, now, 10, 20 years down the road, you're tripling your ounces. Well, you and I have both seen in our lifetime, $50 gold, and now we're at 2,050. Well, imagine instead of having 20 ounces, you have 60 ounces in that type of a growth. That's compounding growth. And you may never even sell it. That may just be something that you pass on to the next generation, and they keep it going for a whole nother generation. These cycles go back decades. We pioneered this back in the 70s, and we've really arguably been the only firm to ever advise and practice it. So that's where the big time effect comes in.
Yeah, Tori, what's interesting about the ratios, even though they've tended to average up over time, you do have some confines within the ratio that you tend to see as outliers to the top end and outliers to the bottom end. So where we're currently sitting at now, around 85, 90 to 1, just above 90 to 1. Well, you can go all the way back to the 1980s, where we saw a move up to around 90 or 100 to 1 at that point, coming off of the previous averages down in the 30s. So we had a very significant move up in that ratio, which coincided with gold and silver price moving accordingly. And then we had an extended period of time where it came down from the late 80s, early 90s, all the way down to 2011. So you have these long-term swings that can take decades up and down. But inside of those swings, You have a couple moves up and down between 90 seems to be a bit of a magical number. So we were above 90 back in the late 80s, early 90s. We hit just under 90 again in 2008, right after the stock market crash, and then it declined all the way to the lowest I've seen in my career, around 31. We came all the way up to 90 again in 2019. Now it continued up from there to 120, but that was very short-lived. That lasted about a month, and it fell all the way back down to about 60. So we're coming back up to 90 again. We hit it again. We've hit it again. So it seems to be a number on the top end that we bump up against. And while it can extend a little bit past that, it's a really good signal that something is probably going to change in a relatively short period of time.
That's exactly right. I appreciate two things you pointed out there. One is how far back this goes. Before it was 90, it was 80. You can do that same sort of a line at the 80 figure that we had topped out. But you mentioned that we're seeing these higher highs in the ratio as well. This is a climbing pattern in the ratio over time, drawing that long-term average higher. Going back to biblical times, it was 16 to 1, and then it was, in the low 30s to 1. Once the Federal Reserve was created, it started to climb, and now here we are at a higher 40-year average of around probably 60 to 1. But looking at what you pointed out, the last three times that we've hit 90 to 1, this is where I'm excited about silver. And for me, it's why silver's at a buy signal. Yes, the price is down below 23 an ounce. I love that. But that coincides with a high ratio, which is why I'm adding a lot of silver to my client portfolios. Because looking back at that 2019 top in the low 90s, in about the next 5 months, it rallied 27.5%. Okay. And then you mentioned again in 2020 when COVID hit, yeah, we came back to the 90, then it hit that all-time high of 125. But just from that starting point of the 90, that ratio came all the way back down to 64. That represented a 70% increase in the silver price in the next 5 months. And then the third time we did this was in 2022 when we got to around 94 to 1. And guess what? Lo and behold, silver rallied 37% in the next 5 months. So I look at the silver chart here, and I'm not saying that the ratio has topped, but I'm actually very excited that in the next 5 to 7 months, it wouldn't surprise me one bit to see a 25% plus or more rally in the silver price, which would coincide with the tightening in the ratio so that this time as an entry point for silver would be validated.
Well, and I think here's something that should also be mentioned. Ratio trading is simple, but it does require some data and some understanding of the markets to make sure you approach it appropriately. Now, the reason I'm saying that is this. If you're buying silver and looking for that perfect move up in silver, honestly, just go buy gold. Because when I look at the prices compared to each other, since over the last 20 years, gold up about 660% in 20 years. Silver's up about 400. So silver is not a replacement for gold. I think that's a very important thing that we should remember, and one of the key reasons why we look at silver the way that we do as a company. Silver is not a gold replacement. What silver is it is a tool to be used appropriately to allow you to increase the quantity of gold that you have. The idea about this, and the reason we call it ratio trading, is you're looking at those relative prices going back and forth, and ultimately the goal of owning silver, looking at silver when we're at these types of ratios, is so that you can own more gold later down the road. That might allow you to own more silver. That'll eventually allow you to own even more gold. So from my perspective, I'm always a gold guy through and through. I care way more about gold than I do any other metal. That's why I buy the other metals. I don't buy silver to own silver. I buy silver to allow me to get more gold.
I'm exactly the same way, and I appreciate you saying that. And yes, it is simple, but it's also complex. Complex enough to where we as a firm have a self-instilled or self-inflicted, if you will, ethical standard or guidelines as to which clients would qualify for a ratio trade at any given point. No broker or advisor can just go do a ratio trade without the client signing off, but no broker or advisor can actually even have the conversation with the client and show them the math until another broker or advisor has co-signed the fact that the math works for that client. Because there are complexities to it from the standpoint, like if you go into high premium silver, you just took yourself out of a ratio trade. You have to deal in industry standard, reasonable premium product. It has to be net of brokerage fees. The whole net gain has to be net of taxes. So if it's not in a retirement account, where it works very well, by the way, but if it's in possession metals versus stored metals, that can add a layer of complexity. And so all of those have to be taken into account. And that's what we'll do with our clients. And so, yes, it's simple. Yes, there are complexities.
So I'm riffing here on the show now, Tori, because I'm listening to you mention this, and it immediately gets me thinking about some of the sales pitch things that I've heard elsewhere. Because I kind of look at it this way. There are two ways that you can look at using metals as an investment asset. You can go into something that has the potential of going up because it has a really nice song and dance attached to it. Or you can go a strategy like ours, which is encouraging you to actually buy the cheapest, most common thing out there so that you can get as much of it as possible for the cheapest price possible. 100-ounce silver bars, 1,000-ounce silver bars, so that we can convert it into even larger quantities of gold coins. You know, when I look at some of these other strategies, like buying modern manufactured collectibles at 3 times the price of silver, because they have a specific red-tailed hawk that Canada happened to put on them this year. Or you can just get as much of it as possible for the cheapest price possible at the right time. Those are two very different investment strategies to build into your long-term gold ownership and gold buying program.
That's right. One adds to that multi-generational compounding ounce effect. The other takes you out of it and puts you into a dead end.
Exactly. Wasn't the plan for the show. Well, I guess it was kind of the plan for the show today, was to talk a little bit about ratio trading. I guess we can divert back to the charts, but it is good to know. And it's kind of fun, even for us who've been doing this so long, it's good to go back and run back through some of the basics of why we look at this, not just in terms of building out a foundation, but growing that foundation or allowing that foundation to grow for you, simply by paying attention to how the markets ebb and flow like anything naturally does. So speaking of ebbing and flowing, let's talk a little bit about how the equities market has been ebbing and flowing, because I'm looking at no end to the rise in the S&P, no end to the rise in the Dow, no end to the rise in the NASDAQ. But then you look at some of the comparative indicators, like last week I mentioned the Russell 2000. So let's pick a different one this week. One of my other favorites, the Dow Transportations. So the Dow Transportations are still floundering. They're still down 11% off the highs in 2021. They're still down off the highs from last year in July of 23. So the Dow Transportations, the shipping, packaging, shipping, transporting of goods and services throughout the world isn't keeping up with the stock price. Well, if they're not, again, I've said this 100 times for years. If you're not shipping goods, you ain't selling goods. So there's no legitimacy to the market rises on the other side right now. It's pure speculation. It's rampant speculation. Great, it's going to go higher. I'll just say it. Equity markets going higher. But I'm still not interested. Not at the S&P where it is, not at the price ratios, not at the Shiller index. Like, I'm just not interested because it's not real. It's not companies manufacturing, selling, and building up their baseline, building up their revenue. It's purely speculative investing. So case in point, if you go back and you look at, say, the separation of the price of, say, the S&P compared to a longer-term moving average, like a 200-day moving average or a 65-week moving average. The separation in percentages over and above that moving average, the last time we saw it at these levels, well, we saw it at 2021, right before the market crashed. We saw it in 2007, right before the market crashed. We saw it in 2000, right before the market crashed. So you have these periods of exuberance at the end of bull markets where things stop making sense, where the laws of physics no longer apply. And it happens every time. You know, it's the third wave of a bull market cycle where it's no longer legitimate. It just becomes speculative. And arguably, looking at the numbers, we're in the same type of position we were in 2007. We're in the same type of position we were in 2000. So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you'd like to discuss your personal portfolio and any future recommendations we may have, feel free to give Tori, myself, or any of the advisors here at McAlvany Precious Metals a call. We can be reached at 800-525-9556. You can find more info on our website at McAlvany.com. We're on Facebook at McAlvany Financial and on Twitter at ICA Gold. Thanks for listening and have a great week.